Hello, and welcome to Portfolio Matters Weekly Markets Checklist, week 155. But before I get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Full disclaimer can be found at the end. First of all, some housekeeping. I'm afraid that you have just me again this week, as Richard is having his boat taken out of the water, but he will be back next week, which will be more fun for all of us. First of all, the news. So the big macro data of the week was Q1 US GDP numbers, and they came out weak. US GDP slowed to 1.6%, although when we go through it, you'll see that was largely due to idiosyncratic factors. The bad news was quarterly PCE inflation jumped sharply to 34.4%, way ahead of expectations. And the monthly PCE inflation number for March is out later today. Bond yields rose, rate expectations rose. The market is now expecting only one rate cut this year. In the Middle East, the Israel-Iran conflict appears to have subsided for now, although on Wednesday it was reported that Israel attacked 40 Hezbollah sites. So there is still the potential for the conflict in the Middle East to get worse. The US has approved 95 billion in aid for Ukraine and Israel, just in time, hopefully, to help Ukraine repel an expected Russian spring offensive. The FTSE 100 hit an all-time high, although that was helped by sterling falling against the dollar. Bank of England chief economist Hugh Pill has contradicted other members of the MPC and saying that it was far too early to consider rate rises. Gilt yields rose and sterling rose on the expectation that UK interest rates would stay higher for longer. Elsewhere in the US, the FTC has banned non-compete clauses, which is fantastic news for US workers and is something that we should copy here in the UK. And finally, BHP has bid for Anglo American in a $37 billion deal in the UK. So this is the US quarterly GDP and PCE inflation numbers. You see the red line is GDP, not great. That fell to 1.6% annualized. And we'll go through that in some detail later. The really bad news was inflation, which leapt to 3.7%. The UK, the FTSE 100, hit a new all-time high. Although inflation adjusted, it's nowhere near an all-time high, which happened back during the great financial crisis. FTSE has not been a great investment over the last 20 years, and it's not an all-time high in dollar terms either. Sterling has been weak, and that has supported the FTSE 100, which has a lot of foreign earnings. The FTSE 100 has also been terrible relative to the rest of the world. So the UK equity market is not doing well, despite the fact it's hit a new nominal high. Elsewhere, the market is now pricing in just one Fed rate cut in 2024, which is a huge change from January when it was pricing in almost 7. And BHP has bid for Anglo American, sending the shares up 16% on the day. Okay, on to this week's economic data. Quick summary, the UK economy is weak, but appears to have bottomed, or at least sentiment has bottomed. The same is true of the EU, where sentiment is actually improving quite sharply. In the US, the economy is strong, but there are signs that the rate of growth is slowing. China, very difficult to tell. The global manufacturing cycle does appear to have turned, but all the latest manufacturing PMIs show it fading again. So it's unclear what the strength of the manufacturing cycle is. Okay, on to the UK. So we had PMIs. The manufacturing PMI actually fell back into recession. Not great, but well up from its lows. The service PMI strengthened, and that is a good number, 54.9, ahead of expectations and up on March. And if the PMIs are to be believed, the UK economy should be growing around trend, but we know it's not. Therefore, it would seem that the PMIs measure sentiment rather than actual economic performance. The public sector borrowing requirement for March was disappointing, and the one for February was also revised down. So the UK government is borrowing more and more and cutting taxes. How does that work? The CBI distributed trades for April was terrible. So it was expected a -2. It came out in as -44. So that suggests that retail is having a hard time in the UK. Business confidence, though, for Q2 improved sharply to +9, and that actually is a decent number. So it seems that businesses everywhere are more confident about the future. Industrial trends, new orders faded again. Disappointing. Expected a -16, it came in at -23, down on March. So although sentiment is improving, the hard data does not appear to be. And consumer confidence improved in April. Expected -20, came in at -19. Not a great number, but as we've talked about before, there seems to be this general drop in consumer confidence everywhere post-pandemic. UK car production is fading again. Now, we talked previously about how the UK car industry has retooled towards electric vehicles. And we also know that electric vehicle sales are disappointing. So has the UK car industry bet on the wrong horse? Citigroup Economic Surprise Index is fading, but still positive. And the Indeed Job Postings Index, I think you can say that is still continuing to fall. Trueflation is heading the wrong way at 3.09%. According to Trueflation, UK inflation is not converging on the 2% target. Though, reminder, a lot of UK inflation occurs between February and May, and Trueflation is not seasonally adjusted. Returning to the UK public sector borrowing requirement, you can see that the current public sector borrowing requirement is very high by historic standards, but hopefully on a downward path. UK summary. While manufacturing PMI fell back into recession, the services PMI strengthened strongly, which meant the composite was okay. According to the PMIs, the UK economy should be operating around trend, but we know it's not. Elsewhere, business confidence has improved, and the PSBR was worse than expected. The bottom line is that the IMF is forecasting UK GDP growth of only 0.5% this year. And although the PMIs are improving, it's not clear that the economy is. Onto the EU, there's a light data week everywhere, but we had the HCOB manufacturing PMIs for April, and again, manufacturing activity fading again. disappointing at 45.6, down on March, below expectations, and not a good number. Services PMI strengthened to 52.9, beating expectations, which meant the composite was at 51.4. So, according to PMIs, EU economy is returning to growth. Consumer confidence missed expectations at minus 14.7, although it was up slightly on March. Citigroup Economic Surprise Index is still positive for the Eurozone. So the Eurozone is doing better than expected. The German job postings still fading, as are French ones, although it had a bit of a bounce last week. So no sign of an upturn in the economy from the job postings. And when we look at the Eurozone in general, and you look at government deficits, this chart shows on the x-axis the average deficit in the pre-pandemic period and the deficit last year. And you'll see France is running a very persistent deficit. And we know that France is already very heavily indebted. How long can that continue? France may well be the sick man of Europe. And the ECB is continuing QT. So it is selling EU government debt. And these are the sales between July 2022 and March 24. You'll see it's, as a percentage of GDP, its biggest sales were actually in Italy and Portugal, though Germany was also large. Summary, the same PMI pattern as in the UK. Manufacturing PMI faded again, falling further into recession. Services PMI strengthened, although we're not seeing any sign that a strengthening services PMI is being translated into either jobs or economic growth. So business confidence is returning to the Eurozone, but it's not clear that that the economy has turned. And while we're talking about the Eurozone, let's talk about the periphery. So last year, in 2023, Greece and Italy far outperformed Germany. So in 2023, the Greek economy grew by 2.5%. German GDP fell by 0.5%. So a lot of commentary has been on how the periphery of the Eurozone is doing very well and the core is sick. Well, let's put this in perspective. Between 2007 and 2022, Greek wages fell 30% in real terms. So over that 15-year period, Greeks had to endure massive fall in living standards. And that 30% fall in real wages is mirrored in a 30% fall in GDP per capita. That is a depression. And that also had an impact on the nation's health. So on the left here, you see Greek life expectancy. And following the great financial crisis, you can see a distinct drop in life expectancy in Greece. The good news is that over the last couple of years, since the pandemic, Greek debt to GDP has fallen by an almost record amount, almost 50%, which is extraordinary. However, that is flattered by the fact the Greek economy collapsed during the pandemic because it's obviously a tourist-driven economy. And so its debt to GDP ratio exploded in 2022 and it's now coming back down towards trend, but inflation and debt write-offs have helped. Meanwhile, in Italy, you'll see that Real wages, which is the light blue line, are lower than when the euro was created. The fundamental problem with the Eurozone is it's a suboptimal currency area. So if an Italian loses his job, he is unlikely to be able to move to, let's say, Denmark to get a new job because of the language barrier, if nothing else. And so changes in national competitiveness must be rectified through adjustments to the real economy rather than through the exchange rate. Hence, real Greek wages falling by 30% over the last 15 years. What is amazing is the willingness of citizens within the Eurozone to undergo extraordinary economic sacrifices to remain within the system. How long can this continue, we ask ourselves. And on to the US. So the big number of the week was Q1 GDP growth, and that came out well below expectations of 1.6%, expected at 2.5% and almost half the Q4 rate. But when you dig into the data, GDP in Q1 was reduced by 0.83% due to trade, i.e. imports, and also by 0.42% due to inventories, both of which are volatile components. If you were to ignore those, then underlying GDP grew by a very respectable 2.9%, still down from Q4 2023, but still strong. And this chart shows government expenditure in green and personal consumption expenditure in purple. And you'll see both fell in Q1, but personal consumption, actually, that looks like a decent number. The fall in the GDP growth rate was primarily caused by falling government expenditure. GDP sales growth, quarter on quarter annualized, came in at only 2% in Q1. So it appears the US economy is slowing, and real consumer spending slowed to 2.5%. As we've discussed regularly on the podcast, US consumers are slowly consuming their excess savings from the pandemic, and that effect will only get worse in the coming quarters. Now, the bad news was that personal consumption expenditure inflation leapt to 3.4% in Q1 at an annualized rate, way above expectations and much higher than Q4 last year. So inflation is resurgent. Core PCE inflation was even worse, rising to 3.7%, above expectations, much higher than Q4 last year. We also had the PMIs. As in the UK and the Eurozone, the manufacturing PMI was very disappointing. It was expected to rise to 52, it fell sharply to 49.9, i.e. manufacturing fell back into recession in April. The services PMI was also very disappointing. It's expected at 52, it came in at 50.9, down on March against an expectation of an improvement. All that added up to a composite of 50.9, down on March, and all that adds up to a US economy that is weakening again, not strengthening. Within the services PMI, this is a worrying chart. The employment component has taken a very sharp drop down. Will that translate into job losses? So far, non-farm payrolls have continually surprised the upside. Will that finally come to an end? And it does appear that there is a correlation between the employment PMI subindex and the unemployment rate. So the employment index inverted is the green line, and the unemployment rate is the orange line. The two do appear to be correlated. Elsewhere, the Chicago Fed National Activity Index for March was strong at 0.15. Reminder, this index is measured in standard deviations. So what it's saying is in March, the US economy was stronger than trend. Durable goods orders for March were strong at 2.6% above expectations and well up on February, although the February number was revised lower. Ex-transport, though, not so good. At 0.2% up on February, but below expectations, and the February number was revised sharply lower. We had the New York Fed Empire State Manufacturing Index for April, mirroring the PMIs in not great, falling to minus 14.3. Richmond Fed also weak and minus 7. Kansas Fed also weak and minus 13. So it generally looks like manufacturing activity in the US is not recovering. The cyclical upturn that we're talking about in previous weeks, months, seems to have come to a halt. The services index from the Richmond Fed also fell to minus 13. Building permits were stronger than expected, but down on February. New home sales actually were good, and that's a decent enough number. The US housing market shows no sign of recession. Johnson Redbook retail sales, they're perfectly respectable at 5.3%. So same store sales data shows the US consumer doing just fine. The 30-year mortgage rate rose with bond yields to 7.24%. And as a result, the mortgage market index is dead as a dodo. Nobody is taking out new mortgages. So how that is compatible with perfectly reasonable home sales continues to mystify me. Initial jobless claims going nowhere, no sign of a pickup in jobless claims. And the continuing jobless claims also going nowhere. The Dallas Fed's weekly GDP estimate actually rose on the week to 2%. So they think the US economy continues to chug along. And the Atlanta Fed's GDP now for Q1 is at 2.7%. We know the first estimate for US GDP is 1.6. So it seems they're being too high. Economic surprise index is fading, but still positive. The Indeed job postings index is falling, continuing to fall. So all the indications are that the US jobs market is fading, and the services employment subindex from the PMI suggests that that is likely to get worse. US trueflation is at 2.28%, so much lower than CPI or PCE inflation, but not fading back towards the 2% target. Now, also in the week, we had the Business Employment Dynamics survey, which is generated from the quarterly census data of employment and wages. And it shows that in Q3 2023, the US actually lost 200,000 jobs. Now, this chart shows the non-farm payrolls in blue and the Business Employment Dynamics survey in red. And you'll see that the two show a very sharp divergence. And previous weeks, we have talked about how there's this big divergence between the non-farm payrolls, which comes out of the establishment survey, and the household survey, which shows much weaker job growth. In fact, a net loss of full-time jobs in the US of over 1 million over the course of the last year. It looks like the household survey is probably right. So the non-farm payrolls data is overstating the strength of the US jobs market. So in summary, the US economy remains strong, but it does appear to be slowing slowly, and the jobs market in particular is also slowing. Higher interest rates do appear to be having an effect and slowing the economy slowly. On to China. No new data this week, but I thought this was interesting. So this is the projected debt pathways of China and the US. And we've talked a lot about how the US fiscal deficit and therefore the US public debt is totally out of control and on an unsustainable path. Well, China is even worse. And China, we know, is as the economy slows, it tries to stimulate the economy through continued malinvestment. How long can that continue? Well, in a command economy, probably much longer than you might think. And we have some data on what house prices in China are actually doing, and it's not good. Pause, take a look at this. So it shows continuing sharp declines in Chinese house prices. That obviously will have big implications for the Chinese property market, and historically, real estate investment has made up a huge chunk of Chinese GDP. If that is now slowing, then the Chinese economy is also likely to be weak. Now, a reminder, official statistics show that Chinese house prices fell just 2.2% in the year to March, and that appears totally inconsistent with the data from the secondary market. So once again, it looks like Chinese statistics are not to be trusted. Bottom line, we can't really trust the Chinese statistics, so I'm not sure what's going on there. And onto one chart. The reason the US economy has done so well when interest rates have risen sharply is that lots of S&P 500 companies, like big companies, fund themselves in the bond market, and they have locked in long-term low interest rate debt. And because of that, they have very good interest coverage ratios. So the black line is the S&P 500. Its interest coverage ratio is 7.6. So they're only spending 15%, 12 to 15% of their earnings on interest. The S&P 600 small cap index is much worse. So smaller companies have less access to the bond market and are more likely to be funding themselves through bank loans, which are linked to interest rates. And they are spending the best part of 40% of their earnings on interest. Their interest coverage is only 2.3 times. So this is further evidence that the Biden's economic policy, which is fiscal largesse combined with high interest rates, is having a disproportionate effect on smaller companies and the poorer members of society. If interest rates are going to slow the US economy, they will do so by squeezing small companies and the poor. While we talk about the fiscal deficit, last week, Joe Biden proposed his 2025 budget. And where we are now is that the US fiscal deficit for 2024 is forecast to be 5.6%. It's then forecast to rise to 6.1% in 2025 and then keep on rising, primarily as a result of interest on the growing debt pile. So if you look at this chart, the light purple is interest payments, and they are responsible for the continual rise in the fiscal deficit. And it could get much worse. So thank you to our Discord member, Miles44, for sending this. This is the outlook for the US interest payments on the federal debt in billions of dollars. And the problem for the US Treasury is that existing debts are continually rolling off and they are being refinanced at current interest rates. So existing debts paying 0.5%, which were issued in the last decade when interest rates were really low, are now being refinanced at 5%, which is current interest rates. And the Treasury is currently issuing T-bills, i.e. short-term debt, which pays close to Fed funds rates at 5.25 to 5.33%, rather than issuing longer-term debt. So new debt being issued is above 5%. So hence, interest on the debt is absolutely skyrocketing as those debts are refinanced. So what's Joe Biden proposing to do about it? Well, the good news is he's proposing to get it under control. So he is proposing to raise taxes by a total of 4.3 trillion and also cut expenditures. The headline is that he would raise corporation tax to 28% from its current 21%. So reminder, Trump cut tax rates from 35 to 21%, which is why the fiscal deficit is so bad. If this were to be enacted, that would mean that US post-tax earnings for corporations would fall by around 9%. The other key tax changes he's proposing are 25% minimum tax on people with wealth of more than 100 million, and no corporate deductions for all compensation over $1 million for employees, which targets high wages of some CEOs. And a marginal tax rate of 39.6% would be applied to households making over $1 million a year. Now, raising taxes would inevitably have a negative effect on the economy. So raising corporate taxes would reduce investment, and cutting the deficit by reducing spending would also reduce GDP. So the Tax Foundation estimate that it would reduce GDP by about 2.2% long term and cut wages by 1.6% and reduce full-time employment by about 790,000 jobs. But something needs to be done. The good news is, if enacted, this would bring the deficit under control. But the bottom line is none of these proposals are close to being enacted. We would need to see who gets into the White House after the election. But if Biden gets in, it's clear where US fiscal policy is going. Higher corporate taxes, which is bad for corporate earnings and therefore equities, and also higher taxes on the wealthy. And now on to PMIs. Now, we cover the PMIs every month, and frankly, it has been very frustrating because there seems to have been very little relationship between the PMIs and the real economy. And these charts show that to be absolutely the case. So The black line is real services spending, and that's 6-month annualized. And the orange line is the global services PMI. And you'll see there seems to be very little correlation between the two, frankly. This is the manufacturing PMI and manufacturing production in the US. Actually, here, the relationship is better, but you'll see that, if anything, the manufacturing PMI is a lagging indicator. It turns down after industrial production and recovers later. The ISM, non-manufacturing PMI, is frankly even worse. It shows no relationship whatsoever to services expenditure. And the ISM manufacturing PMI, again, very poor, shows no relationship whatsoever to industrial production. So, in summary, the services PMIs seem to be a very poor guide to anything, and manufacturing PMIs are little better. They would seem to be a guide to sentiment within the industries rather than to anything else. So we will continue to report them, but they should be treated with a great deal of caution. And now on to US unemployment. So over the past year, US unemployment has risen from 3.5% last March to 3.8% now. U6 unemployment has risen more sharply from 6.6% last year to 7.3% now. Reminder, U6 includes underemployed and discouraged workers. But there has been no rise in unemployment claims. In fact, continuing unemployment claims are actually lower than the same time last year. What's going on? So the unemployment rate is rising, but people aren't signing on. The question is, how do you define somebody who is unemployed? Actually, so this is the question from the survey, and the survey says, did you do any work for pay or profit last week? If the answer is yes, then you're not unemployed. And Michael Green, the hedge fund manager, has this theory that people are not signing on and not becoming unemployed because when they're made redundant, they sign on to work for Uber instead. So the claimant count is not rising because people are just working part-time for Uber. And so this is the seasonal variation in US unemployment over the period since the 1950s, and the red line is Uber. And you see the seasonal variation has been dropping. So his point is people signing on to Uber reduce seasonal unemployment, and is evidence that alternative part-time work is reducing the volatility of the unemployment figures. So this is the difference between the minimum and maximum unemployment rate over the previous year. And you can see seasonality has continued to decline, although it was declining pre-Uber. And this chart shows the dollar value of unemployment benefits relative to average earnings, and they are at a new low. So the incentive to sign on for unemployment benefits has fallen. But I would say that that is the wrong metric to look at. When you look at US unemployment benefits, which are paid by individual states, the maximum that they pay varies between states, and varies between a minimum of $362 a week to a maximum of $804 a week. In all cases, unemployment benefit is paid for a maximum of 26 weeks. Now, Uber, its pay rates are estimated to be between $8.55 and $11.77 an hour, which is terrible. And actually, if you're working a 40-hour week, it is far better to sign on. 97% of Uber drivers do not last a year. They find alternative employment in that period. So hence, I'm not convinced by this at all. I don't think that you can say that the unemployment claims are not going up because people are signing on for Uber. It would be far better to sign on at McDonald's. Hence, I think the low unemployment claims are probably just a function of a decent economy. And on to US car insurance again. US inflation is resurgent, and one of the key reasons for that, as we've covered in previous weeks, is that US car insurance premiums have been rising very sharply. They're up 22% year on year and 51% since January 2021. This shows the annual rate of inflation. It's shooting up. Now, it can't carry on rising at that rate forever. And as we talked previously, it's forecast to rise 7% in 2024. So that rate should start to fall. Now, the reason US car insurance rates are rising is that Americans are having more accidents are more severe, and repair costs are higher. And we previously discussed this as being due to a rise in distracted driving. Now, the FT had a report this week on US car insurance, and they were talking about how this appears to be a particular US phenomenon. So US road accident fatality rates per 100,000 people in 2020 were 11.4 per 100,000. And that compares to just 2.9 in Spain, 3.3 in Israel, and 6.3 in New Zealand. Cyclist fatalities rose 44% between 2010 and 2020. So here in the US, which is the red line, car occupant fatality rates have been rising in recent years, particularly in the most dangerous US states. And pedestrian deaths have been rising very sharply. That trend is going in entirely the wrong direction and is still rising. Having been to the States recently, the first thing you notice is how big the cars are. So are SUVs the cause of this steady rise in pedestrian fatalities? The answer is actually no. The rise in SUVs and light trucks is not just a US phenomenon. It's also observed in Canada, Australia, and New Zealand, where road fatality rates, pedestrian fatality rates, have been steadily declining. It's only in the US that they've been rising. Notice also the scale on these charts. That is enormous. 80% of cars in the US, Canada, Australia are SUVs or light trucks. So the underlying cause appears to be risk appetite. Compared to Canadians, Americans are more likely to break the speed limit and much more likely to be looking at their phones. Now, another aspect of road safety and human behavior is that as we feel safer, we feel able to engage in more risky behavior. So as US cars have got bigger, safer with airbags and seatbelts, etc., that allows drivers to engage in more risky behavior. This is called risk homeostasis. So if you think about what happens when you feel you're in a risky environment. So say that you hire a car in a new country and you don't know the laws, and it's driving on the wrong side of the road. You are more likely to be driving very cautiously and to be very highly risk averse. As you feel safer, then you become less risk averse. You may no longer wear your seatbelt or drive faster and look at your phone. So making cars safer can have the perverse effect of making car drivers feel more comfortable and drive faster. So the point is that current high inflation is not a function of excess demand. It's a function of shelter prices, which are we've covered many times, is a lagging indicator, and motor vehicle insurance, which is a function of a lagging price effect, but mainly a change in people's behaviors. So keeping interest rates higher for longer to combat the headline CPI numbers risks actually slowing the economy and having little effect on inflation. Obviously, so far, they don't appear to be slowing the US economy at all. But as you saw earlier, the jobs market is slowing, and the latest services PMI employment intentions data suggests it will slow further in the coming months. And that brings us on to Tesla. So Tesla had its results last week and they were terrible. So Q1 revenues fell to 21.3 billion, below expectations and down 15% quarter on quarter. And when you look at this chart, it would seem that Tesla has very much gone ex-growth, as EV sales growth has fallen and Tesla has been cutting prices. Earnings per share were 42 cents, missing estimates, and well down on the peak of $1.19 in Q4 2022. And its gross profit margin fell to 17.6. Again, massively down from its peak as it's cut prices to stimulate demand. So free cash flow collapsed. But Elon Musk turned things around by promising to bring forward some new low-cost vehicles, and the shares leapt 20%. It's now on a forward PE ratio of 48 for a company with falling revenues that appears to have gone ex-growth. And finally, onto the UK minimum wage. So in April, the national minimum wage rose again to £11.44. And since 1999, the national minimum wage has increased from £3.63 to £11.44. That's an absolutely enormous increase over the last quarter of a century. And as a result of that, low-paid worker wages have risen much faster than the median. And this is shown and this chart shows that in the period 1975 to 1999, which is the light pink bars, higher paid workers had the strongest pay growth. So inequality grew. Since 1999, because of the rise in minimum wages, inequality has fallen. So the lowest paid workers have seen the highest wage growth. This chart shows the wage growth for cleaners, sales assistants, and bar staff. And again, they've grown much faster than medium. And it's not just workers on the minimum wage who have seen strong wage growth. And when you raise the wages of people below the minimum wage, you also had to raise wages of people above the minimum pay scale in order to maintain a wage differential between employees of different grade. And so this chart shows the change in wages of employees by where they are in the pay scale. So the further you are to the right, the further away you are from the minimum wage. And it shows that the change, as the minimum wage came in, workers below the minimum wage collapsed, but workers, the wages of people on the minimum wage rose very sharply. But then there was a declining effect further up the pay scale. So it didn't just affect workers below the minimum wage moving to the minimum wage. It also had the effect of increasing wages higher up in the pay scale. But that effect is mainly confined to companies that employ a lot of low-paid workers. So economists would say that raising the minimum wage would have the effect of reducing employment. But lots of studies have been done on the UK minimum wage, and that does not appear to have been the case. Actually, it appears there's been no reduction in employment or hours worked, including no effect on overtime, shift pay, annual leave, or pension provisions. The gender pay gap has also fallen because a lot of female workers work in the cleaning sector and low-paid work. There does appear to have been a reduction in employment for part-time workers, though. And also, there's been a reduction in job inflow and outflow, i.e. the job retention rate has improved. But the reason we're talking about this is, what is the effect on inflation? The minimum wage surely raises prices, particularly in the industries affected. Now, in a 2020 study, Frontier Economics found that the price elasticity of companies exposed to the minimum wage was about 0.02 to 0.11, i.e., when the minimum wage rises by 9.8%, as it did this year, it's likely to increase inflation in those industries by between 0.2 and 1.07%, which is not trivial, actually. The Bank of England estimates that it will raise overall wage inflation by 0.3%, with a lower impact on overall inflation. So if we apply the maximum elasticity of 0.1 to overall wage inflation, it should increase UK inflation by around 3 basis points, i.e. not very much. So the rise in the minimum wage is not going to cause UK inflation to stay higher for longer. And that brings us on to Inflation Watch. Now, we only had one new number out this week, and that was Japanese inflation, and Japanese inflation faded to 2.6% core, 2.7% headline. Now, the FT had a piece on the difference between US and EU inflation, and this is US inflation, and the pink bars are labor market tightness. And you can see that a tight labor market in the US has been responsible for a lot of the persistent inflation in the US, whereas in the EU, it's been negligible. So tight labor markets, excess demand in the US has been responsible for strong inflation. In the EU, that is absent. But in both cases, the pandemic largesse led to a huge surge in nominal demand, which is the primary cause of inflation everywhere. If you print a lot of money, give it to the population, then they're going to spend it. Nominal demand shoots up. But the good news in the Eurozone is that M2 has fallen back and is now below trend. In the US, M2 has fallen back, but is now on trend. So inflation, if inflation is a monetary phenomenon, in both cases, inflation should be coming back under control. And currently the market is very concerned about resurgent US inflation, but actually the numbers so far appear to show the vast majority of US inflation is being caused by shelter, which is a lagging indicator and entirely confected. It's essentially a homeowner's estimate of what they would pay to hire their own home. PCE numbers in the US are out later today. But if you measures which have a lower weight on inflation, like PCE, show lower inflation. And as rents are falling, so PCE shelter inflation should continue to fall in the coming months, and that should bring US inflation down. But most importantly, wage growth is falling. The latest Indeed wage tracker has job postings wage inflation about 3.1%. If wage growth falls, inflation should fall. Nominal demand should fall. Because productivity is rising, even though wages are rising in the US, labor costs are not rising as fast because you've got productivity. Wage growth adjusted for productivity was only 2.5% in Q3, and that, frankly, is pretty much compatible with the 2% target. The key point is that when you look at US inflation, which is running hot, it's running hot because of shelter, healthcare, and auto insurance, all of which are lagging. So they are still adjusting for the price shock of the pandemic. So far, there is little evidence that inflation is resurgent. M2, though, has returned to growth. Meanwhile, Goldman are bullish on US GDP, but they're also bullish on US inflation. They think that inflation will fade, allowing the Fed to cut 3 times this year. However, rising oil prices mean rising gas prices everywhere. That will cause inflation to rise, and although that is actually deflationary, i.e. it sucks demand out of the economy, it will also cause central banks to keep rates higher for longer, so that will tend to slow the economy. And sadly, the US is just not on track to hit its 2% target unless you get a slowing economy. So in order for the US to hit 2% by mid-year, you would need monthly CPI of 0.1% going forward. And it's not on target to do that currently. But the surge in inflation during the pandemic was caused by unprecedented COVID fiscal stimulus and supply chain disruptions. It was not caused by persistent wage inflation as in the 1970s. And so I see little chance of a second big wave of inflation, which is what is concerning the market at the moment. So in summary, inflation is currently running hot in the US, largely due to shelter, healthcare, and insurance, all of which are lagging. Wage inflation is slowing. Labor productivity is rising, which means labor cost inflation is falling even faster than wages. All that adds up to, I don't see a resurgence in inflation. But because headline inflation is higher, interest rates will need to stay higher for longer, which would tend to slow the economy further. On to recession watch. Well, reminder, US excess savings should almost be exhausted, although we've said that many times before, and this chart has been revised many times before. But further to last week's discussion of credit card default rates, we had Discover Financial reporting its Q1 earnings this week, and it showed a sharp rise in its credit card charge-off rate to 5.7%, the highest since the pandemic, and rising very sharply quarter on quarter. Now, if you look at different credit card providers, Discover is an outlier, and the smaller credit card providers seem to be most exposed to poor quality debtors, but the rise in the default rate is a general phenomena, and there is no sign of that trend halting soon. Meanwhile, the US savings rate is hovering near its all-time lows, and at some stage, surely, as the pandemic excess savings are exhausted, the US consumers are going to need to start saving again, and all of which would mean lower demand. And Harvard University have this indicator, looks at home refurbishment activity, and having grown throughout 2023, it's now forecast to fall in the coming quarters. So will that translate to slowing construction activity? Lumber prices have been falling, which again suggests that US construction market is not doing as well as it has been. So bottom line, a soft landing is not a given. But on to soft landing watch. Well, this is the CHIPS Act grants to individual companies, and you'll see that, we talked previously about Biden's economic policy and how its distributional effects. Well, it's handing out big money to big corporations. When you look at consensus GDP forecasts for 2024, they're just continuing to rise. The market thinks the US economy is doing absolutely fine and will continue to do absolutely fine throughout the year. Hence, concerned about resurgent inflation. Corporate credit spreads are extraordinarily low. Actually, they're lowest in history. And financial conditions are benign. The market thinks there's no danger of corporate defaults. And we've talked previously about how credit card default rates are rising. Well, auto loan default rates appear to have peaked, at least for now. And that's a good thing. So bottom line, US economy showing little sign of recession, and onto other charts. Now, in the US, it has been puzzling how US home sales have held up incredibly well under the as interest rates have risen, and further evidence of a two-speed economy. It's held up well because the rich have done very well out of the economy of the pandemic, have been buying luxury homes. Sales of non-luxury homes have fallen. And we talk about Tesla earlier. In the year to 2024, sales of battery electric vehicles actually fell quite sharply across Europe as subsidies came to an end. The electric vehicle transition is stalling. And after that, you need some good news. Well, I hesitate to discuss this with the audience, but it appears cannabis is good for your brain. So cannabis has already been shown to relieve short-term chronic pain, reduce inflammation, and improve symptoms of Crohn's disease, which is a bowel complaint. Now, a study in the journal Current Alzheimer's Research looked at 4,744 Americans over the age of 45 and found that those who used cannabis recreationally had a 96% lower chance of developing subjective cognitive decline, whatever that is. So it appears that although cannabis can be very bad for youths, it doesn't appear to be bad for older people, if you believe the study. Anyway, don't go out and buy a spliff. And on to equities. Well, after a poor last week, generally equities around the world bounced back a bit. So this is the all world index, and that was up 1%. All share had a very good week, up 2.7%, helped by BHP bidding for Anglo American. Euro stocks was up 1%. S&P up 0.9%, up 5.8% on the year. Nasdaq up 0.1%, up 4% on the year. The Russell 2000 is failing once again to hold the 2000 level. It was up 2% on the week, but is now down 3% on the year. The wider mass of US companies are not doing as well. Hang Seng had an amazing week, up 9%, and that puts it up on the year. Topics up 2.3%, 13.5% year to date. Bitcoin pretty flat, still up 50% on the year. Sterling recovered a bit, up 0.6%. Euro the same. The dollar index faded, but is still up 4.2% on the year. VIX, having risen as on that Nasdaq sell-off, has now collapsed again and is extraordinarily low by historic standards. And this is the general path of the S&P 500 in an election year. Now, the dip we've seen in the last couple of weeks is bang on seasonality, as US citizens have to pay their taxes and therefore they have to sell equities in order to raise some cash. And the general pattern is for the S&P 500 to go nowhere for the next month and then to start rising from June onwards. Consensus expectations are that S&P 500 earnings will start growing again from here. Now, in order for that to be true, you would expect the US economy needs to grow, needs to strengthen from here, and I think it's going to be weakening from here. So that would suggest earnings expectations are too high, with negative implications for the stock market. And since October, equities have had an extraordinary run given very little change in the economy and very high interest rates. It's mainly been driven by enthusiasm over AI. Now, certainly in the case of Nvidia, that enthusiasm is backed by real earnings. But when manias pops and enthusiasms pop, the price action can be absolutely brutal. So this is the share price of Peloton, which during the pandemic, when everyone was stuck at home and people were buying Pelotons, the market extrapolated growth to an absolutely ludicrous degree, and shares are now down 98% from their peak. Virgin Galactic, shares down 98%. Zoom, which we use to record PM, share price down 90% from its peak, and that is despite Zoom quarterly revenues increasing tenfold over the period. The problem was that Zoom was on a price to sales ratio of 124 times, which is just absolutely insane. It's now on a price sales ratio of 4. So Zoom actually did deliver very good revenue growth, but expectations were just absurd. And so that is the danger of buying very expensive growth companies. And on to commodities. So this week, oil rose, gas fell, industrial commodities were generally strong, copper and zinc continuing to climb. Precious metals fell back a bit from their recent highs. PGMs, well, it looks like PGMs are fading again. So looking at energy, Brent was up 1.7%, and frankly, it looks like that bull market is intact. Reminder, OPEC has 3 million barrels of spare capacity as in charge of this market. How high will they let oil prices go before they start to open the taps? This is WTI, up 0.4% on the week. And there was a crude drawdown in the US. So US market was undersupplied last week. US oil production was stable at 13.1 million barrels, down 200,000 barrels a day from the start of the year. The Baker Hughes rig count, though, is rising, up 5 on the week, up 11 on the year. Now, the front page cover of this week's weekly is Namibia. Now, the Portuguese oil company Galp Energia have drilled the second of their assessment wells in their Mopani discovery offshore Namibia, and they now estimate it contains 10 billion barrels of light oil, which, if confirmed, would make this one of the largest offshore oil fields in the world. And it seems that just like Guyana, offshore Namibia is turning into an interesting exploration play. And on our Discord, there is now a dedicated channel for people interested in the Atlantic margin oil plays. And if you're interested, please sign on. This is from the UK listed oil exploration company Eco Atlantic, and it has licenses close to where other oil companies such as Shell have made discoveries. Elsewhere, Russian oil exports have fallen sharply after Ukraine attacked Russian oil refineries. So that is helping support the oil price. If you look at global oil stocks, well, the US has been running down its oil inventories. China has been building them enormously. Now, in the case of the US has moved from a massive importer of oil to a net exporter. And so hence you could argue that it needs less oil in inventory because it's self-sufficient. Not sure why China has been building its strategic petroleum reserve to such an extent, but that is also supporting the oil price. Moving on to natural gas, well, good news is that European natural gas futures fell by 8.8% last week. So the recent rise on disruption from the Middle East appears to have faded again. That's good news. Same is true for the UK. US natural gas futures continuing to drop. There's terrible price action. There is a gas glut in the US. Coal prices also fell back and down 6.5% on the year. Uranium is fading. Onto industrial metals. So After a huge rise over the last month, aluminium fell again, but is still 8.4% up on the year. Cobalt going nowhere, down on the year. Copper, wow, up another 2.9% last week, up almost 20% year to date. So we're talking about how medium term there is a shortage of copper. Well, price action this week, if you've waited and been patient, you are being rewarded. Medium term, we know that a shortage of copper is almost inevitable. But the Chinese are stockpiling copper. What are they up to? Chromium going nowhere, down on the year. Iron ore recovering from its sharp falls earlier in the year. Lithium, flat. Neodymium, up from its lows. Has it found a bottom? Still down 11% on the year. Nickel, despite the coming glut of nickel from Indonesia, the nickel price has been rising the last few weeks, up 2% last week, up 18% year to date. Tin, having spiked, has fallen back, but still up 25% on the year. Ferrovanadium going nowhere. Zinc actually joining in. So generally, industrial metals having a good start to the year. Precious metals, gold fell back, but has stabilized, up 14% year to date. Richard will be happy. And it appears that's being driven by Chinese speculators. Western ETF volumes have not risen. Silver faded, with gold down 2.6% on the week, down up 14% year to date. Platinum going nowhere, down 2.5% on the week, down 4% on the year. Rhodium, brief excitement as its share price did something, well, doing nothing again. Palladium fading. And finally onto rates. Well, bad inflation numbers in the US led to a rise in rates across the world. Terrible for me. So this is the UK yield curve, risen strongly over the last month. The US yield curve even worse. So this is my problem in one chart. I was expecting that real yields to revert to their post-GFC average. As debt has increased enormously and high interest rates would slow the economy and slow inflation. And sadly, that has not happened as yet. Real yields have continued to stay very high, but Goldman Sachs is expecting Treasury yields to fall by the end of the year. The Treasury market does not expect that. And hedge funds are very short Treasuries, which raises the possibility of a sharp snapback as crowded trades tend to unwind very quickly. But over the course of the last few weeks, the UK 2-year has risen quite sharply. The 10-year is terrible, rising back towards its highs of late last year, and that's the 30-year. Again, terrible, terrible for me. US 10-year, awful numbers. Those are the highest of the year and really back towards the highs as inflation has proved persistent. German 10-year has followed international yields higher, despite the fact it looks like the ECB is on track to start cutting rates in June. Italian, actually, not following Germany. Greece, not too bad. So concluding comments. Well, US GDP came in weaker than expected, largely due to idiosyncratic factors. The underlying economy appears to still be strong, but there are growing indications that the jobs market in the US is slowing. Quarterly PCE inflation came in hot. The monthly numbers are out today. Inflation is persistent in the US, but mainly, I believe, due to lagging effects. Inflation is due to an excess of demand. Wage growth is slowing. As long as that continues, inflation should come down. But bottom line is markets are worried about resurgent inflation. And finally, onto the crimes and misdemeanors section. Well, I'm having an absolutely terrible time. I have bet big that the rise in interest rates would slow the economy and bring inflation under control. And that has not happened. Bond yields are rising and I'm getting killed. And all rather tedious and embarrassing. But I still think that ultimately will come good. Now, so last week I lost 2.3%, despite the fact I cut the book. And thank God I did 3 weeks ago. So that gives me cash to put to work if I see opportunities. And I still think that given where we are with interest rates very high, that interest rates will need to come down. Inflation will come down as in the excess demand falls and wage inflation falls. So medium term, I just don't see how highly indebted economies with unchanged economic growth outlooks can support higher interest rates. Reminder that interest rates long term are a function of the productivity of the economy. So high productivity economies can produce excess profits, which they can use to pay higher interest rates. Low productivity can't. Interest rates are a product of productivity. So going forward, I expect interest rates to come back down again, and that to bail me out of this disastrous bond trade. But so far, it absolutely has not worked. It's been a total disaster. And this is the cause of my pain, which is T68, not T69. It has an implied real yield of 1.3%, an implied inflation of 3.3%. Now, if you buy this, you are going to get real yield, tax-free, pretty much, plus inflation of 1.3% a year. So, although currently I'm not looking very clever, frankly, given we know that corporate tax rates are likely to rise and high interest rates should slow the economy, I am quite happy having a lot of bonds. I think that's the right place to be. The trouble is, I should have been buying them now rather than when I did. Now, this is the chart that got me into a lot of trouble in that essentially I was expecting mean reversion. And if I can get to 100, I'm bailed out of this trade. Now it hit a peak of 325. And frankly, I was expecting the prices to go back towards where they were mid-cycle at 2014, which would be, 125. So if we do get a recession, if we do get a slowdown, I fully expect to get out of this trade actually alive and with a profit. And I now have resources to buy back in when I see a trend develop. But right now it's not working. And right now I'm not looking very clever. So that's it for this week. Another depressing week for me. And next week, hopefully Richard should be back, which would be better for all of us. But in the meantime, please can you press like and subscribe to the channel. And it's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.